Americans think the Fed only changes rates in public meetings, 8 scheduled gatherings per year, press conferences, Jerome Powell at the podium, headlines about quarter-point moves. That's not where the most important decisions actually happen. The real direction gets decided weeks earlier. In technical adjustments that sound boring, in balance sheet operations that don't make news, in facility announcements buried in footnotes. By the time rate decisions reach headlines, the market has already moved. This isn't a conspiracy. It's how modern central banking actually works. December 10th, 2025, the Federal Reserve announced something most people missed while focusing on the quarter-point rate cut. Starting December 12th, the Fed would begin purchasing $40 billion in Treasury bills per month. Not quantitative easing, they insisted. Reserve management purchases, technical operations to maintain ample reserves in the banking system. The language was deliberately dry. The implications are anything but. Because this represents a fundamental shift in Fed policy that happens to coincide with exactly the kind of liquidity pressure that preceded every major financial stress event of the past 2 decades. Let me explain what actually happened and why it matters more than the rate cut everyone was watching. When the Fed changes incentives, behavior changes even if rates don't. For 3 years, since June 2022, the Federal Reserve ran quantitative tightening. They let their balance sheet shrink from $9 trillion down to $6.5 trillion by December 2025. That's $2.5 trillion in securities that matured and weren't replaced. $2.5 trillion in reserves drained from the banking system. The process concluded officially on December 1st, 2025. 9 days later, the Fed reversed course, not with drama, not with emergency announcements, with a technical operation to buy $40 billion per month in short-term Treasury securities. The Federal Reserve balance sheet, as of January 7th, 2026, stands at $6.54 trillion, down from about $800 billion in December 2005. An increase from around 6% to 21% of GDP over 20 years. The expansion primarily reflected 2 massive policy decisions: quantitative easing during the 2008 financial crisis, more quantitative easing during COVID. Now as the Fed tries to normalize, they've discovered something uncomfortable. The banking system can't function smoothly with reserve levels where they currently sit. Money markets show stress. Overnight funding rates spike unpredictably. Treasury markets experience volatility. The Fed calls this reaching ample reserves. What it actually means is they removed too much liquidity and now have to add some back. Here's why this matters. By the time rate decisions reach headlines, the real direction has already been decided weeks earlier. The October 2025 FOMC meeting announced the Fed would conclude balance sheet runoff in December. That was the signal. The actual date, December 1st. The purchase announcement, December 10th. The implementation, December 12th. Each step executed quietly. No emergency tone, no market panic, just technical adjustments that happen to inject massive liquidity exactly when funding markets show strain. Markets don't panic when liquidity appears. They panic when it disappears. That's the pattern people miss. Let me take you back to 2008 because this is the historical mirror that matters. When people think about the financial crisis, they remember Lehman Brothers failing, stock markets crashing, bailouts. What they don't remember is how the Fed's most important actions weren't announced in dramatic press conferences. They were implemented quietly through facilities most people had never heard of. In March 2008, the Fed created the Primary Dealer Credit Facility, an overnight loan facility for securities broker-dealers who aren't banks. The Fed had never lent to non-bank entities on this scale before. The PDCF was announced March 16, 2008. Bear Stearns used $28.5 billion immediately. The facility stayed open until February 2010. Peak usage exceeded $150 billion. September 2008, after Lehman failed and Reserve Primary Fund broke the buck, the Fed launched the asset-backed commercial paper money market mutual fund liquidity facility. Try saying that 3 times fast. AMLF for short. The Fed provided non-recourse loans to banks so they could buy commercial paper from money market funds that were experiencing massive redemptions. Peak usage, $152 billion. The program was announced September 19, 2008, closed February 1, 2010. October 2008, the commercial paper funding facility. The Fed created a limited liability company that bought 3-month commercial paper directly from issuers. At its peak, the CPFF held $350 billion in commercial paper. These weren't small technical adjustments. These were the largest emergency liquidity operations in Federal Reserve history, and most of them weren't fully disclosed until years afterward. Some programs were only completely revealed following Freedom of Information Act requests, congressional mandates, and the Dodd-Frank Act. Section 13(3) of the Federal Reserve Act allows emergency lending in unusual and exigent circumstances. That authority was used extensively in 2008. Peak emergency lending hit $710 billion in November 2008, and the public knew some version of this was happening. But the full-scale, The specific counterparties, the exact terms, those details came out much later, not because of conspiracy, because central bank operations prioritize market stability over public transparency in real time. By the time the public understood the full scope of 2008 interventions, markets had already moved. Bear Stearns got acquired. Lehman failed. AIG got $85 billion. Citigroup got guarantees. Markets reacted before the public understood why. Now look at what's happening today. The Fed isn't calling this quantitative easing. They're calling it reserve management purchases. The distinction matters for political and communication reasons. Quantitative easing sounds like stimulus. Reserve management sounds technical. But the economic effect is similar. The Fed is expanding its balance sheet, buying securities, injecting reserves into the banking system, providing liquidity. The $40 billion per month pace is substantial. Sustained over a year, that's $480 billion. The Fed stated this elevated pace will continue for several months, specifically to counter anticipated large increases in non-reserve liabilities in April 2026. Then, purchases will likely slow, but continue at some ongoing rate to maintain ample reserves. What changed that forced this reversal? The overnight reverse repo facility, on RRP for short. This is where money market funds and other eligible counterparties can park cash overnight with the Fed and earn interest. For years, on RRP balances were massive, over $2 trillion at peak. As the Fed raised rates and let the balance sheet shrink, those balances declined. Though September 2025, on RRP usage fell to nearly zero. That sounds good until you understand what it means. The cash that was parked at the Fed earning safe returns had to go somewhere else. It went into Treasury bills, it went into repo markets, it went into overnight funding, and that created pressure. When too many dollars chase too few high-quality liquid assets, you get rate volatility. You get funding squeezes. You get exactly what happened in September 2019 when repo rates spiked to 10% overnight. The Fed had to intervene with emergency repo operations. That episode taught the Fed a lesson. You can't drain reserves indefinitely without hitting friction. There's a level of ample reserves below which money markets stop functioning smoothly. The Fed thought they were managing this carefully. They slowed runoff in March 2025. They stopped runoff completely December 1st. And 9 days later they reversed to buying because the signal said ample reserves had been reached, maybe slightly breached. Here's what you need to understand about signals versus announcements. The Fed communicates through actions more than words. The announcement of purchase operations says the confirmation of a decision already made. The actual policy shift happened when internal Fed research and money market indicators showed reserve scarcity risks. That probably happened weeks or months before December 10th. By the time the announcement came, the decision was done. The operations desk at the New York Fed had already prepared. Counterparties already knew this was likely. Markets started adjusting. The public announcement is the lagging indicator. Think about incentives. When the Fed buys $40 billion in Treasury bills per month, who benefits? Primary dealers who sell those bills to the Fed get cash. Banks whose customers sell bills get reserve deposits. The overall financial system gets more liquidity. Interest rates on short-term funding get pushed down because there's more cash available. Asset prices tend to rise because liquidity supports valuations, credit becomes easier, risk appetite increases. None of this requires a rate cut. The balance sheet expansion does the work. That's why the Fed insists this isn't quantitative easing, because politically, quantitative easing suggests stimulus. But economically, expanding the balance sheet is stimulative regardless of what you call it. Now let's talk about what this change is, not tomorrow, but over time. The Fed spent 3 years trying to normalize its balance sheet after COVID. Trying to get back to pre-crisis norms, they got from $9 trillion to $6.5 trillion, and discovered they couldn't go much further without breaking something. What that means is, the new normal isn't $800 billion like 2005. New normal is probably $6 to $7 trillion, maybe higher. Roughly 20 to 25% of GDP, because the financial system evolved. Banks hold more reserves for regulatory reasons. Money market funds need safe, short-term assets. Treasury issuance is massive and needs buyers. The Fed balance sheet has to be large enough to provide those functions. This matters for everything else. If the Fed balance sheet stays elevated permanently, that's permanent liquidity support for asset prices. Not extreme levels like COVID, but above historical norms. It means interest rates across the curve stay somewhat compressed because the Fed is a buyer. It means credit availability remains easier than it would be with a smaller Fed footprint. And it means the next crisis, whenever it comes, starts from a Fed balance sheet that's already large. There's less room to expand, less ammunition. The emergency tools get smaller. Look at the timeline. June 2022, quantitative tightening begins. March 2025, the pace slows. October 2025, announcement that runoff will end. December 1st, 2025, runoff officially concludes. December 10th, purchase operations announced. December 12th, purchases begin. This isn't reactive crisis management. This is planned transition. The Fed saw the data, monitored reserve levels, watched money market stress indicators, decided when to pivot, executed the pivot smoothly. No drama. No emergency weekend meetings. Just technical operations implementing a decision made months ago in internal Fed discussions the public never saw. That's what behind closed doors actually means. Not secret conspiracies. Just the normal process, where staff economists analyze data, brief senior officials, run models, debate policy options, and reach conclusions that get announced weeks later once the language is finalized and the logistics are ready. The important decision that reserves needed to stop declining and start increasing that was made before October. October announcement was setting the stage. The December announcement was execution. The public learns about it in reverse order. First the execution, then eventually maybe some research papers explaining the analysis that led to the decision. I can hear you thinking, if this mattered, markets would panic. But markets don't panic when liquidity appears. They rallied. The S&P 500 gained, the dollar weakened. Treasury yields mostly fell. Because markets understand this is accommodative. This is the Fed making credit easier. Not through rate cuts, through liquidity provision. The mechanism is different, but the effect is similar. More liquidity, more risk appetite, higher asset prices. That's the pattern. It doesn't require panic. It requires understanding what the operations actually do. Now let me show you the signals that told you this was coming before the announcement. Overnight and reverse repo, balances declining towards zero through 2025. That's money leaving the Fed's facility looking for alternatives. Repo rate volatility increasing. You could see this in secured overnight financing rate. Softer movements. Treasury bill issuance, overwhelming dealer capacity to absorb. The Treasury general account at the Fed fluctuating more than normal. These are observable indicators in public data. They don't tell you exactly what the Fed will do or when, but they tell you the Fed is seeing the same pressures you're seeing, and the Fed has tools to respond. The Federal Reserve balance sheet as of January 7th, 2026. Total assets $6.54 trillion. Securities held outright $6.27 trillion. Treasury securities $4.23 trillion. Mortgage-backed securities $2.04 trillion. The Treasury bill holdings specifically increased by $39 billion over the prior year. That's the signal right there. Composition is shifting. More bills, fewer longer-term securities. Because bills are what you buy for reserve management. Bills are what money market funds need. Bills are what keeps short-term funding markets functioning. Let's talk about what doesn't change. The Fed's dual mandate, maximum employment and price stability. The target inflation rate of 2%, the current policy rate range of 3.5 to 3.75% as of December 2025. The dot plot showing one more cut expected in 2026, another in 2027. That's the public-facing policy. That's what gets headlines. That's what Jerome Powell discusses in press conferences. Behind that, the balance sheet operations continue. The reserve management purchases inject liquidity. The standing repo facility provides a backstop when overnight funding rates spike. The discount window remains available for banks that need emergency liquidity. These tools operate continuously regardless of rate policy. Here's what actually changes. The assumption that the Fed can normalize its balance sheet to pre-crisis levels is bed. $6.5 trillion is the new floor, not a waypoint to something lower. The assumption that rate policy and balance sheet policy are separate is revealed as incomplete. They interact. Large balance sheet plus lower rates equals very accommodative. Small balance sheet plus higher rates equals very tight. Where we are now, large balance sheet with moderate rates, that's moderately accommodative, regardless of the headline rate number. And the assumption that Fed transparency means you know everything in real time is wrong. You know what the Fed chooses to announce when they choose to announce it. The analysis and debate that led to the announcement happened earlier, internally, in processes you never see. This doesn't make the Fed villains. It makes them central bankers operating the way central banks operate. They manage the financial system. They respond to data. They make technical adjustments. They communicate what they think markets need to hear. Sometimes that's months after decisions were functionally made. Not because of conspiracy, but because central banking involves managing expectations, and you can't manage expectations if you're constantly announcing internal debates and preliminary analysis. You announce conclusions. You execute plans. You explain later if needed. What you should watch now, reserve balances. The Fed stated they want reserves somewhat above ample levels. That probably means 3.5 to 4 trillion in reserves. As of January 7th, 2026, reserve balances were not published in the snippet I found, but tracking this through the H.4.1 release every week tells you if the Fed is succeeding in adding reserves or if they need to buy more. Repo market stress. If sulfur volatility increases or Secured overnight financing, spreads widen, that's pressure. The Fed will respond with more purchases or standing repo operations. Treasury bill supply. The Treasury has to issue bills to finance the government. If issuance overwhelms demand, yields spike, and the Fed becomes buyer of last resort. That's happening quietly already. Standing repo facility usage. The Fed removed the $500 billion aggregate daily limit on these operations in December 2025. That's a signal they expect usage might increase. If banks and dealers start using standing repo regularly, it means they need liquidity the private market isn't providing. The Fed stands ready. But usage is a stress indicator. Finally, the pace of reserve management purchases. The Fed said $40 billion per month initially, elevated for several months, then declining to some lower ongoing rate. If they never decline, or if they increase instead, that tells you ample reserves requires more liquidity than they thought. The goalpost moved. The system needs a bigger Fed balance sheet. Here's the reality most people don't want to acknowledge. The financial system fundamentally changed after 2008. It changed again after COVID. The size and complexity increased. Regulation increased reserve requirements. Treasury debt outstanding exploded. Money market funds grew enormous. All of these create demand for safe, liquid assets. The Fed balance sheet is a primary source of those assets through reserves and through being a reliable buyer of treasuries. You can't shrink the balance sheet back to 2005 levels when the system is 5 times larger. The Fed tried. They got to $6.5 trillion and hit resistance. This is the new equilibrium. That equilibrium has consequences. Permanently elevated central bank footprint in financial markets. Permanently lower interest rates than fundamentals might suggest because the Fed is a structural bid. Permanently easier credit conditions than would exist in a pure private market. Permanently higher asset valuations than would exist without that Fed liquidity support. None of this is good or bad, inherently. It's just the reality of modern central banking in a financialized economy with massive government debt. The Fed provides the plumbing. The plumbing has to be sized appropriately. Turns out appropriate is much larger than it used to be. What the Fed just did behind closed doors, or more accurately, in technical operations announced in dry language most people ignored, will change everything, not by causing a crisis, by preventing one. By providing liquidity when money markets showed stress. By reversing course before stress became crisis. Markets don't reward that kind of prevention. There's no headline that says Fed successfully avoided crisis through timely technical adjustments. The headline is Fed cuts rates. And everyone focuses on the rate while missing the balance sheet operation that mattered more. This is how the most important Fed decisions work. They're administrative. They're technical. They're boring. They sound like inside baseball for financial plumbers. They determine whether credit flows or seizes, whether markets function smoothly or break, whether the next recession is normal or catastrophic. The rate cuts get attention. Balance sheet operations do the work, and by the time they're visible to the general public, markets have already moved, because the people who pay attention to balance sheets and reserve levels in repo markets and treasury bill auctions saw this coming. They positioned ahead of time. They understood that when almond RRP goes to zero and reserve metrics flash warning signs, the Fed will respond. It's not prediction, it's pattern recognition. The most important Fed decisions are never dramatic. They're administrative, technical, executed quietly while everyone watches something else. And by the time they're visible, markets have already moved. That's not a flaw in the system. That's how the system works. Understanding that gives you an advantage, not because you can front-run the Fed. You can't. But because you can recognize when the Fed is signaling direction through technical operations long before the public conversation catches up. December 10th, 2025 was one of those signals. $40 billion per month in Treasury bill purchases, labeled reserve management, actually accommodation. The balance sheet is expanding again, liquidity is returning, asset prices have support, credit conditions are easing. None of that requires rate cuts. It just requires understanding what the Fed is actually doing versus what they're saying they're doing. And if you understand that distinction, you understand more than most people watching the quarterly press conferences waiting for Jerome Powell to tell you what changed. By the time he tells you, it already happened. The decision was made weeks ago. The operations began days ago. Markets adjusted hours ago. You're learning about it now. That's the reality of Fed watching. You either understand the technical operations and see the signals early, or you wait for announcements and learn about decisions after they've been implemented. The choice is yours, but the timing matters. Because markets move on information, and the information most people watch is lagging.